I think that the market is really, instead of trying to not fight the Fed, I think the market is trying to push the Fed.
Investors are looking closely at Fed comments this week for views on the latest economic data and the policy outlook following last Friday's surprisingly strong inflation report, that PCE report. We got PCE on Friday, showing some heat is still there in inflation. What does all of this mean for the interest rate outlook in your view?
Well, it's been just a fascinating year to date, where we've seen rates rally and stocks rally really hard in January and then completely reverse course in February.
One of the most buzzed words these days is none other than inflation. And the path to arresting inflation in the United States might be more zigzaggy and not quite so straightforward. This is largely due to the fact that inflation has been on the rise worldwide, in response to which the Federal Reserve has been taking steps via rate hikes. In today's video, Cathie Wood examines the current state of inflation and the Federal Reserve's policies. She also lays out a possible framework for the future of inflation. If you're interested in learning more about inflation and the Federal Reserve and how it impacts the economy and the market, stay tuned until the end of this video. She's also shared her advice for the investors. And of course, be sure to subscribe to Wealthy Value for more videos just like this one. You can also hit that bell icon to never miss any video. Let's get into it. The Federal Reserve's recent statements regarding inflation and interest rates has caused quite a stir in the markets. You see, in both the US and in Europe, the latest readings suggest interest rates will have to go higher and possibly stay there longer, with effects that will ripple around the globe. You see, Bitcoin and Ethereum are trading flat. It's a similar narrative across other markets in crypto. Analysts expect the sideways action to continue during the week, seeing that most of the forced sellers in the short squeeze that pushed Bitcoin above 24K have sold, while other investors play it safe until there's a clearer picture on which way the Federal Reserve is going on rate hikes. Let's get into the next clip to hear more from Cathie Wood.
I think the Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And sure, maybe they go up another 25 basis points, maybe 50, I don't know. But I think we're just about there. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay. This is going to date me. This reminds me of early in my career. In the early 80s, it was the same thing. But those who bet on lower inflation and interest rates long term were the winners. And it's always the data are very volatile, especially when you have the warmest winter in history here in the Northeast. So I think that's distorted the numbers quite significantly. And the interesting thing about seasonal factors, if that is the distortion, they all have to work out to 1 over the full year. So if they bumped the numbers disproportionately in January, it'll come out of other...
Lately, there's been a growing interest in the topic of inflation. The numbers are not good. Inflation is starting to pick up again in the coming months. As for the Fed's preferred measure of inflation, the Personal Consumption Expenditures Index, the headline figure rose to 5.4% from 5.3% the previous month, and core inflation rose to 4.7% from 4.6% the previous month. The headline and core PCE numbers were well above expectations. What worries us the most is that the data since the last Fed meeting has been extremely strong. If the Fed had this data at the last meeting, they probably would have raised by 50 basis points. The Fed targets a 2% inflation rate, and that looks like a long road. Markets are now better on higher interest rates for a longer period of time.
You know, it's very interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust, and people fearing that we may be in the same situation. We are not. In fact, the seeds for everything that's happening today, all of the innovation that's happening today, they were planted in the 20 years that ended in the tech and telecom bubble. But the technologies back then were not ready. the costs were way too high. We didn't get the big breakthroughs in artificial intelligence until deep learning 2012, transformer technology 2017, and now finally we have a chat GPT. People are beginning to understand that the ground is shifting underneath us when it comes to innovation. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history.
The market is at a crossroads. The rise in rates could have a bad impact on the crypto market. Some analysts have warned that the Fed's rate hikes could choke off the bull market by making borrowing more expensive. And in such an uncertain environment, it's no wonder that investors are nervous. However, while there may be reasons to be cautious, there are also reasons to be bullish on the market. You see, so far, the market has held up surprisingly well in the face of higher rates. Bitcoin has finally stopped correlating with Nasdaq. Cathie Wood also highlighted that it's time to invest in innovation, not to run for the hills. Let's get into the next clip to hear Cathie Wood's viewpoint on the crypto market. And of course, be sure to give this video a big thumbs up.
When it comes to crypto, Bitcoin has had a spectacular start to the year, up 39%. It's more aligned with innovation strategies performance. And so up 39%, but it is down 39% on a year-over-year basis, as many other assets are down on a year-over-year basis still because of what happened with monetary policy last year. So we're in a risk-on market, and nothing goes straight up, and we don't want it to. We want orderly markets, but it sure is nice to be on the other side of what we believe, when history is told, will be a mistake on the part of the Fed. This inflation was transitory, and we do believe that interest rates will start coming down toward the end of this year. Public blockchains, we go through and show why we're even more confident now that crypto assets are going to rival and redefine traditional asset classes. Crypto assets being valued at the end of 22 at roughly 1 trillion. We could see 25 trillion, a 25-fold increase by 2030. I know that our Bitcoin price got a lot of press this week, our price forecast. And yes, we are recommitting to the $1 million. Of course, we've had to take assumptions for corporate treasury uses of Bitcoin on balance sheets and nation-state treasury uses. Those have come down a bit. But still, we do expect our base case for Bitcoin for 2030 is almost $700,000, and our bull case is roughly double that.
Bitcoin ended in the red on Sunday for the third week in 4, hurt by the prospect of higher for longer interest rates to damp inflation. A regulatory clampdown in the US after the collapse of the FTX exchange is also squeezing the sector. And yet, Cathie Wood is bullish on crypto and the market. Even as many top experts are split on the outlook for the economy, markets appear stuck digesting a host of mixed signals, from strong economic data on the one hand to fears of higher rates on the other. In the end, though, it's still the Fed that will most likely have the last word. But what about you guys? Let me know your thoughts in the comment section below. For more videos on the economy, crypto, and market trends, be sure to subscribe to my channel. You can also hit that bell icon to never miss any video. I'll see you guys in the next video. Adios, and thanks for watching.